How do you do, excuse me, how do you do, ladies and gentlemen? Welcome to today's briefing. It is Wednesday, April 29th, 2020. We're going to talk about the uh, stock markets, the indices around the world. This pattern that we're looking at on the S&P 500 on a daily chart, these bars represent daily movement, um, um, point into the eyes of some traders that it's time to buy in. Price has fallen far enough, and there are bargains, and it's going to recover. People are starting to return to work. Orders restricting movement are being rescinded and relaxed around the world, um, and there's a lot of that encourages people to say, "Oh, okay, maybe this is it. Maybe this miserable curse, is behind us." We're here to say that we think otherwise, and what I think we should be thinking in terms of next week and things to sell and how to sell it is, um, there's way more to continue to fall here, and we need to really start driving the concept of selling short home, because that's markets are liquid. We're still up and trading. Our firm and every other firm. This is not a financial crisis. There's plenty of liquidity in the financial industry, and Lord knows the central banks of the world have doled out zillions and trillions is the term, trillions of yen, euro, zillion numbers that are unimaginable, that have surpassed the outlay after Pearl Harbor. I mean, nothing in the history of recorded economics, is anything this lavish, which has huge social and economic implications for later down the road, after we sort of can, brace ourselves for, or try to brace ourselves through what is just now the early stages of the beginnings of this misery. I don't know. The numbers are quite astounding, and I don't want to go into the epidemiological numbers, but suffice it to say that the world everywhere is aware of this, whether they believe in this trend or this trend, and we're going to try to make the case for the fact that there's a lot more of downward pressure here to be understood. And this is, again, uh, we can share the fact that we use Fibonacci in this particular case. It's certainly credible and reliable. I don't use it that much for you. It's not useful on a daily, regular basis. I only take it out of the bag when you see it's just extreme movements, and so the recovery from those extreme movements are often indicated quite well by this tool. And the point I want to make here is that this 50% retracement is psychologically very important. Look, you can see the fear. You can this is sort of human reaction to fright in graphic form. There's some shock. This whole period of time is less than a month, or just about a month. And it falls, whatever it is, that 30%, some unbelievable amount of decline. I can tell you, actually, there's an interesting chart that became available on TradingView, and I want to present it to you now. It compares on a weekly. These indicators are weekly. This gentleman presented it for the purpose of showing the uh, the high beta, or the high volatility right before a decline, which is interesting in itself, except for the fact that one was entirely a financial explosion in 1929, and this is caused by a natural pandemic that occurs in nature. But here, in terms of magnitude, this is a 49% drop in what the weeks. This looks like probably about 6 months, maybe. This is about maybe 2 months, but still, the question is, do you see this uprise? This, okay, God, look at that fall. Guy, I still got a little cash left. I haven't been wiped out. I'll buy in. I'll buy in some more. Yeah, and people buy into it, literally buy into it until, this, by the way, if we this goes to 1932. By the way, it's 1929. 30, 31, 30, 32, and if we saw the rest of the graph, it really doesn't sort of start to end its fall until like 1936. It goes up very slightly until of course Pearl Harbor, at which point it vavoom. But Lord forbid that happens here. The question is like this, though. How far can this really go? How much further can it go? And it's utter speculation. It's impossible to know. But if we start taking a look at some technical indicators, and there are some clues here. You'll notice on these declines, the volumes are tremendous. The highest volume here is way, way above the norm, and that is an attempt to buy in at this stage. But look, all of the volume right up to here is all negative, all negative. And it's way, way above. So there's a tremendous amount of one-sided pushing here by the sellers, and they drive price down. A little bit here. The bulls try to fight back here once. One day they managed, no, 2 days in a row, but significantly less the second day. And then the bears are taken over again with a way above average price, right down to the bottom. At which point the bulls do take over, but the volume is decreasing. So this rise is being is dominated by fewer bulls than this fall was by the bears that drove it. And that is a crucial indicator of sentiment. And sentiment is to, price movement as momentum is to acceleration. It's an integral part, and it indicates the future potential or lack thereof to continue the trend. And in this case, this is a strong indicator that this is likely to fail at some point. Now, let's take a look specifically at the Fibonacci here. This is the 50% line. So it penetrated it, tested it, failed, went under it, penetrated it again, and is pushing up to that 61 level. And 61 level is a much, much more significant line. And if it would stay above that, then a lot of people will come in. But this rise is what could be termed, if of course you have this picture in your mind, which you should, because the types of, and let's talk about this for a minute. I don't want to overdwell on this. I don't want to make this overly long, but these are just percentage drops in this price chart. The Dow Jones Industrial Average, it was completely different. I don't think there may be. I think once General Electric fell off the Dow Jones, there are no old timers left. They're all gone. Everybody on today's Dow Jones are companies that I don't think are older than 50 years old, most of them. But nonetheless, there are other statistics that you don't see in this chart that are highly, highly correlatable. For example, the extreme unemployment and the instantaneousness of the rise in unemployment. The last week, this week, we're going to see NFP next week, and this NFP, by the way, we said this last month. Last month's NFP was significantly damaging, 700,000 or some, 7 million, I forget. I really forget. Negative, but it's surely, no, it must have been 7 million, way more than expected. But this one is going to be, in the double digits, easily in the double digits, maybe in the hitting 20 or more million new claimants for unemployment. So that statistic is probably parallel, if not exceeds in magnitude, the 1929 ravage. And of course, the corporate failure, and this is what this represents. This represents the corporate failure, and so. Okay, this is 30, what is it? I think it's 38%, 39%, 38 and 49, right? So this is significantly more, maybe 20% more in terms of magnitude, but still, the numbers here are much higher. This is that point that the Dow Jones was hovering around 400, went to 2, that's 50%, and this is 28 to 20, so this is only about, say 30, well, here it tells you right there, 39%, yeah. So, serious business. Serious business. Now, to the last thing, I'll just spend a moment on this, but this is I think important. This comes out of the rubric of human psychology. This you can see is deeply human. A deep shock, a deep reaction, and an exhaustion, a clear exhaustion in that reaction, therefore not likely to be able to sustain said reaction for much longer, coupled with what will likely to be proved, or could at least easily be understood to be able to prove will be a another round, another peaking of the disease curve, and the reproduction rate. That R rate will go above 1 again, if not much higher, in places that can't really bear to 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 live, live in their house anymore. That they're starving to death, whatever it is. They want to get back to work. They want to open up the bowling alleys, whatever. In Florida, they decided, well, whatever. Never mind the specifics. There's a lot of ill-advised policy being considered and in certain places undertaken that may or could very well lead to a serious increase in the R rate, and in places where they either don't have the medical facilities or what medical facilities they have are exhausted from the first round, if they had a first round at all. Anyway, it's likely to continue for some time. And so we need to sell the message to our people: sell short, sell and sell short, and we can do it. You can come and trade in our markets. We are able to profit from declines. People are selling off. We can also sell off. We can piggyback on that trend because it's very, very, very strong and powerful. There are great indicators out there showing us that it's likely to continue. Just one last quick look at this. Keep this chart in mind. Keep this chart in mind. We could easily go back to prices that we saw, in 2012. When you don't see it here on this chart, but only then when prices started to recover from 2011. Depends on how you date, or according to what standard you define a recovery. But it goes back. We have been in a long bull run here for at least 8 years in our reckoning, and this pandemic was completely unexpected, completely unprepared for. It's wreaking terrible damage. The earnings reports are showing it. Companies are not talking about anything like dividends anymore, earnings per share. They're talking about solvency. The name of this game is to have a strong solvency. By the way, means having more assets than you have liabilities, and on the cash flow side, the income statement side, having being fairly liquid. Liquid means having cash, the ability to liquidate obligations, the ability to transact. So it's liquidity, and solvency that are front and center in earnings report season, and nobody's expecting anybody to hit targets or miss targets or pay dividends or everything is, except for very few. And we've mentioned them in the sense of J&J. We mentioned them in the sense of possibly Facebook, Netflix for sure, Amazon obviously, but the majority of what's going on is selling. People want to liquidate. They want to get into cash. Cash is king, and they don't want to be holding assets that are losing value, and we can profit from that. We can sell short something we don't have because we'll be able to buy it back later because the markets themselves are liquid. So with that, I'm going to end today's briefing, and let's try and make some money today. Goodbye for now.